Hello and good morning, listeners. Welcome back to Almus Market Mornings. And folks, we had the GDP numbers released for the previous quarter yesterday, and it was on the softer side. But there's more to those numbers beyond the statement. Although the numbers were softer, we still are poised to achieve the 7% growth target for the fiscal year, despite the global slowdown as per CEA. On global front, after numerous misplaced bets on the terminal rates for the US, market participants have now started boosting their expectations on the terminal rates for Eurozone around 4%. So this kind of mixed bag data and mixed bag expectations. What do you think, JK? What's your expectations?
Yes, I think yesterday's strong numbers, yesterday's data was on the weak side. After a series of strong numbers we had seen earlier in the month, particularly in the manufacturing sector, a couple of indicators like Richmond Fed Composite Manufacturing Index and Chicago PMI both falling well below expectations, and they also came below the mark, previous month. And Chicago PMI particularly extended its fall for sixth straight month. These data show that hefty rate hikes by Fed is having its impact on the manufacturing activity. Surprisingly, consumer confidence index decreased in February again, and from 106 to 102.9, and the expectation index was also down at 69.7 from 76 in January. The expectation index has fallen below 80, a level which signals a recession within the next year. This is what is seen historically, and it has been below this level for 11 of the last 12 months. So there are two indicators. One is a yield curve and this expectation index from consumers that possibly indicate a recession in the US economy. Data helped yields retrace somewhat, particularly in the long end, after testing higher again in the wake of stronger than expected inflation numbers from France and Spain. This has upped the expectation for Eurozone flash inflation number due tomorrow, earlier expected to moderate. As you said, the ECB terminal rates are now being pegged at 4%, and with an outcome being priced at 90% probability. BOE is also expected to, the Bank of England is also expected to raise rates by 25 basis points to 4.25% next month, and the money markets are pricing a 50% chance of a 5% BOE rate by December. So we have not only the US yields rising, but also yields rising in other major economies. So the differentials with the US is not really widening, which keeps the currencies well supported against the dollar. There was more selling of stocks yesterday, with recession indicator, that is a 2/10 yield curve, further steepening to almost 90 points. Poor consumer confidence data and another downtick in manufacturing sector has once again raised fears of recession going ahead. And after a strong performance in January, stocks have retreated in February, with economic data and also the comment from Federal Reserve prompting market participants to consider odds of central bank hiking rates to a higher level than what was forecast earlier. In Europe too, German bond yields headed to their largest monthly rise in the month of February since 1991, while the UK yields headed for their biggest February rise since 2005. So these rises are supporting the rise in respective currencies, although they have fallen back since because of a slight risk aversion. They seem to be well supported at 1.0550 for the euro and 1.20 for the pound, and with the market noting that US yields rises are well matched by these countries as well. Yen, of course, stands out because the new nominee for the BOJ head is continuing to indicate continuation of easy money policy, and the yield rises elsewhere is helping the yen lower as well. Today's China factory activity data came higher for the first time in 7 months, driven by renewed upturn in production and new orders, and revived customer demand as the China shook off its strict COVID curbs. And the private sector survey showed that CX showed the purchasing manager index rising to 51.6. That's the expansion territory from 49.2 the month prior. and even beating the expectations of 50.2. So it's restored the risk sentiment a bit, but overall fears of recession gaining ground in the US keeps the assets slightly on the defensive. S&P Global surveys on manufacturing and services in these coming days will be watched closely. Eurozone flash inflation numbers are due tomorrow. That also needs to be watched for the direction on the euro. Overall, dollar should hold ranges till these numbers are released, and particularly they may even hold till the jobs data next week, with some expecting that employment data might get worsened in the coming months. Yes, on the Indian side, the rupee surprisingly showed some resilience despite the hotter than expected US PCE inflation data released last Friday, initially spurred by continued intervention from RBI, and then now we are hearing of some large inflows of bond issuances by some of the PSUs, and we have broken below the 8260, which was holding for some time, and augurs well for some more gains in this month, particularly when we normally expect bunched up inflows as well as exporter elevated hedging activity. GDP number yesterday obviously came lower than expected. Particularly what was disappointing was lower consumption. On the brighter side, the capex held up, and so this 4.4% was not totally a surprise, because this is what was indicated by the RBI monetary policy forecast also in the month of December, and 6.8% is what they have indicated for full year GDP, whereas the government is now indicating the estimated 7%. So overall, India is still maintaining its leadership as far as the growth trajectory is concerned, and that should augur well for long-term investments, although near-term is driven by the risk sentiment as well as the US monetary policy. Yeah, thank you very much.
Yes, JK, definitely. I mean, India's growth story is quite eminent, and everyone's talking about it. So, continued growth of Indian economy, be it at 6.8%, or the government mentioned 7%, will still augur well for the flows to come in. And with flows, we'll see some bit of appreciation in USD INR if they drop by. So yes, we can see already a lot of central bank intervention to prevent any sort of significant volatility or weakness in the currency. But at the same time, the domestic factors of lower consumption and capex, higher capex, have continued to bring in the mixed bag results. At the same time, on the global front, I really liked the focus on not just the inverted yield curve, but it is also the consumer confidence, which is now pointing towards an impending recession. It only needs to be seen whether we really are through with this talk of transitionary and higher inflation for a higher period narratives to a now impending recession narrative. On the other side, risk sentiments were also seen restoring on a probable recovery from China. So there's a lot of mixed bag results, as we have been mentioning, across economies, folks. We shall continue to bring in all the updates for you. That's it for today. Thank you so much for listening.